This is video 2 of 3 for the Chapter 1 Class Notes and Cost Accounting. Reminder that we're going through just a basic introduction of what cost accounting is, how it's used, why it's valuable. In this video, we're going to talk about cost data, work through some examples of how we might project cost. First, we begin here. So cost for decision making. Two important terms here. Cost driver. A cost driver is just some factor that drives or basically causes cost. You could think of it as the underlying cause of a cost. A reason why there's a cost. Then we have differential, emphasis on that word, cost or revenues. So differential cost are just differences in cost between one or more alternatives or one or more options. Basically how costs differ. Differential revenues, how revenues differ between two alternatives or even one or more alternatives or two or more alternatives. Basically just differences in costs, differences in revenues between different alternatives that we could pursue. So if I'm faced with making a decision about a couple different alternative options that I have that I could pursue, I want to do a cost-benefit analysis that focuses on comparisons of the differences in costs and the differences in benefits or revenues between my alternatives. So it can be really helpful if you're comparing them to be able to identify the cost drivers associated with alternatives. Largely because if I can identify the cost drivers which contribute or drive the cost, then I can better understand why and how costs might change with each alternative by looking for differences in those cost drivers. So for example, if I were looking at an alternative that, say I was a bakery, I was looking at some alternative and it would require me to make more cupcakes. Making more cupcakes is going to require more labor. So I know that the number of cupcakes produced is going to have this direct effect on my labor cost. I could take what I know about that cost driver and look for differences in what they'll have to produce in terms of cupcakes in this instance, and it will give me insight into what my expected cost would be for the alternatives. Note that if I'm evaluating alternatives, so basically these are two options I have that I've not done either of them yet. So maybe I don't have great info or I don't have exact knowledge of exactly what the costs and benefits of these alternatives are going to be. I'm going to have to estimate these future costs, future benefits. I'm not expecting us to have exact info. These are estimates based off of our best judgment. So it's not going to be exact data. These are estimates. That's okay. We're estimating them based off of solid information, hopefully, about cost drivers and expectations in the market. But they're estimates still. So that kind of fits with cost accounting being a future-oriented accounting system. It's not necessarily concerned so much with what these costs were in the past, unless that's relevant to what they are in the future. It's mostly looking at how to best project the best estimates of those costs and benefits for the future. Note if I'm evaluating alternatives that I want to focus on how they differ. So if a cost remains the same between option A and option B, that cost isn't really relevant. It's going to be there regardless. The costs that are relevant are the ones where this cost for option A is maybe $500 and I don't incur that cost at all for option B. Those differences between their costs are what we're concerned with when making decisions. So we're not just focused with overall cost and revenues, we're focusing on how alternatives, costs and revenues, or costs and benefits will differ from one another. Okay, so let's do this example here. We have AM Bakery. They have a small bakery shop. They make and sell baked goods. Adam is the owner. He has the opportunity to expand his operations by bringing in a food truck to sell baked goods at a nearby office park. So that's in addition to his current small shop. Would he be more profitable to continue limiting his bakery to just that small shop, or would he be more profitable if he expanded to open these new operations in a food truck? So basically, is he better off with just the small shop, or is he better off with the food truck plus the small shop, or the small shop plus the food truck? So as is just the small shop. This expanded with the food truck as if he added the food truck to his operations. So we're going to evaluate whether or not he should expand his operations. This is the predicted change. So if he decided to expand the food truck, this is how the given info says that costs or benefits will change from the current status quo, or from just continuing with the small shop. So if he decides to utilize the food truck, his sales of $11,200 are projected to go up by 50%. Essentially, they should be 150% of what they are now. So 11,200 times 1.5 is 16,800. Note that if you're wondering how I got that, they're going to increase 50%. You could have also done this by saying 11,200 times 0.5. So we're saying they would increase 5,600. So that's in addition to the 11,200, 16,800. Multiplying by 1.5 is just acknowledging the 1 is basically the 11,200 as it is, 11,200 times 100%, plus the increase, which is 50% of that 11,200, so the 0.5. So that is all that math is. So here, if it's going to increase 45%, means it's 145% of what it is now, or multiplied by 1.45. So the ingredient cost going up 45%, $3,915 total for the food truck. Labor cost going up by 45%. So times 1.45. $44. $95. $500 going up 20% for utilities, so times 1.2. 500 times 1.2. Total is 600 with the food truck. My rent will not change, so 900 plus 0, 900. Marketing costs will triple, so they would be triple what they are now, so times 3. 25 times 3, $75. Before I had no truck lease, but now it's going to go up $900. So 0 plus 900. Truck operating expenses had none before, going to go up 150. So add 150 there. So my truck lease cost now 900. Truck operating expenses projected to be 150. So in total, my cost, which basically are here to here, 3915 plus 44.95 plus 600 plus 900 plus 75 plus 900 plus 150, 11,035. That is in total cost. So those have a negative effect. So my operating profits, so my sales minus my expenses or cost, 16,800, my sales up here, minus 11,035, $57.65. So here, let's start calculating the differences. We're just looking at 11,200 minus, so that 11,200. Let's do this the other way. 16,800 minus that 11,200. That is 5,600 more in revenues. Remember, costs have a negative effect. So 3915 minus 2,700. Costs are 1,215 higher, so that is 1,215 more negative. Labor costs are higher too, 44.95 minus that 3,100. So more negative, 1,395. My utilities went from being 500 to being 600, so those have increased. It's going to be negative 600 minus 500, be $100. Rent did not change, 900 minus 900, no change. Marketing went from 25 up to 75, so it's increased, so negative effect. 75 minus 25 is 50. Truck lease went from 0 up to 900, so it has increased. So it's got a negative effect. 900. 0 to 150, increased by 150. It's cost, so it has a negative effect, negative 150. So my differential revenues here are 5,600. My differential cost, here all the costs are. They're all negative, except for the one that's 0, but that doesn't really matter. We're just going to get all these together. 1215, 1395, 100, 50, 900, 150. In total, differential costs of 3,810. Note that should also be the same. if I took that 11,035 minus the 7225, 3810. So now take the 5600 in differential revenues minus the 3810 in differential cost. That is $1,790. Note that is my differential income, the difference in income between the two alternatives. It's positive, it's greater than zero, so that means it adds to income. Operating or taking on the food truck would lead to higher profits, is what that means, or higher income. So what should AM Bakery do? They should expand and open the food truck. Because doing so causes differential income to be greater than zero, so it contributes to income. So doing that would increase my income by $1,790 above what it was when I was just in the small shop. Or I could say that my differential revenues, that 5,600, was greater than the cost of 3,810. So doing so means that we would earn more than our cost. So it more than covers its own cost. It actually contributes, once again, to income. So we earn, our benefits are greater than our cost. Revenues are essentially our benefits. Okay. So in that way, that cost info can help us evaluate alternatives. Cost info can also be used in controls and be used to help us evaluate our own performance and identify areas for improvement. Specifically, we typically mean used for controls and evaluations, as in these costs can filter into a budget. So it can be used to establish or inform controls, particularly budgets. And management normally feels responsible to hold themselves to that budget, or to meet or beat the budget, if you will. Cost accounting info is often used to help inform or build that budget. So in using it to help build the budget, it helps set these benchmarks. It can also be used to help evaluate managers' performance against that budget, with the initial costs that were pulled to help build the budget, with those helping to set the benchmarks they're being compared against. Using budgets to help guide evaluations can help shed light on whether these outcomes that we've actually realized, whether they align with our expectations that are set by the benchmarks from cost accounting, as in the benchmarks that were informed by cost accounting information in the budget. So it helps identify where we've fallen short where we've excelled, where we might improve. Yeah. It also can help refine our expectations for the future. So before we go about really using costs in these ways, as part of inputs and controls or evaluations, we first need to establish who's responsible for what, or establish responsibility centers, where we set responsibilities for certain business functions, who have specific managers who feel responsible for those functions of the business. Basically, establishing responsibilities helps us establish accountability. They feel like this is applicable to them, they know they'll be evaluated against it. It makes them responsible to that budget. Every responsibility center gets its own budget. So things that are in their control are in their budget. That budget is a control, basically knowing that you're being held to this kind of directs your decisions and behaviors accordingly. And the reason why it's impactful oftentimes too is because they know it'll be used as the basis for evaluation. But while knowing it's going to be used as a basis for evaluation helps inform or helps it be a control because they feel more accountable knowing that they're going to be looked at against it, it also provides a benchmark for evaluations later on. So it can help identify specific gaps. It can help identify areas where they've excelled. It's really useful for reforming our expectations and shifting our strategies. So those managers are responsible for those budget targets, meeting or exceeding them. The benefits here of the budget is it helps managers along the way. It's like before we get to the end, it helps them start seeing whether they're meeting their goals. Basically, that benchmark is there, it's communicated to them. They can track where they are and see how their performance is measuring up against the budget. So it helps them make adjustments, even maybe before we get to the final stage where we're evaluating what actually happened with the budget. Once we get to the final stage and actual outcomes are out, they can use the budget to help themselves identify gaps in their performance and to realign their expectations, to find opportunities to do better. They can use it to inform future budgets and future actions. So basic overall process, simplified for preparing and using the budget. Managers oftentimes get to participate in making the budget they're held to. Not saying they have complete say, but they have some say at least. So they help prepare their budgets with the knowledge they have of their business functions, setting their expectations for revenues and costs for the future period. Once that period is over, the budget is used to compare or to evaluate or to identify gaps in outcomes. Basically, they compare what actually happened to what they had expected to happen in the budget, and they identify differences. Then they learn from those differences. They try to get down to explaining why the differences occurred the way they did, both the positive and the negative differences. And once they can kind of assess what led to differences in their outcomes, they can use that insight to help adjust their future expectations or to identify opportunities for improvement or change in the business. So here, this is just what we had budgeted was going to happen. And these are some actual costs that we have for these items. So we're at the part where we're evaluating our differences or identifying differences here. So I thought I was going to spend $3,700 for flour. I ended up spending $3,900. So I spent $200 more. My actual costs were $200 higher. That would have a negative effect. For butter, I thought I was going to spend $34. I ended up spending $35. Once again, I spent more. That would have a negative effect of $100. For oil, thought I would spend $18. Ended up spending less. That would have a positive impact. I spent less than expected, so I saved money. For fruit, thought I would spend $1,000, ended up spending more at $300 or $1,300, so I spent $300 more. That's a $300 negative effect. I'm sorry, let me reshift how I'm focusing or how I'm doing these. Let's say costs are $200 higher. They were $100 higher here, $100 less here, $300 higher here. Nuts. Thought I was going to spend $800, ended up spending $900, so they were higher than I expected by $100. Chocolate. Thought I would spend $800, ended up actually spending $800, so there's no difference there. Other ingredients, thought I would spend $300, ended up spending more than that at $400. So those ingredient costs were $100 higher. Come back to that blank there in a minute. For labor, for the channel manager, thought I'd spend $4,500, ended up actually spending $4,500, so no change there. For other, thought I would spend $10,900, ended up spending less than that. So those costs were lower than expected by $200. 0 minus 200 is negative 200. Utilities, thought I would spend $2,300, ended up spending $2,400, so I spent more by $100. Thought I would spend $3,600, ended up actually spending $3,600, so no difference. For rent, for marketing, thought I would spend $100, ended up spending more than that at $200. 200 minus 100, so costs were $100 higher. Revenues, thought they would be $52,200. They were $52,200, so no difference for those. Let's see what my total difference in costs were for ingredients. So 200 minus 100 plus 300 plus 100 plus 100. That is $700 higher cost. I could have also got that by looking at 12,500 minus 11,800. Also 700 positive or $700 in higher cost. For labor, I had $200 and my costs were $200 lower than expected. So 700 minus the 200, so that and that, plus 100 plus 100 should be the complete total. So $700 in higher cost. My revenues did not change, so my cost went up by $700. The $0 change minus the $700 increase in cost. I guess I should have kept it the way I had it before. It doesn't really matter how you assign signs to these as long as you understand higher cost means less income. Higher revenues means more income. Lower cost would also mean more income. So the signs you assign to them here are not super important. Understanding what their impact on income is. The difference in their income from what they expected be $700. Than they expected. $700 lower than they expected. Okay, that is the end of video 2. We'll pick back up with video 3 at the top of page 7.